In this video, we're going to look at the elimination of the parent's share in the equity of the subsidiary on consolidation. And by now you should understand that on consolidation, we pause a pre-acquisition equity entry to eliminate the parent share of the subsidiary's equity. That is different from the transactions or the journal entries that we pause for NCI's share of the subsidiary's equity. As we don't eliminate their share, we just extract it and disclose it separately. But in this video, we look only at the parent share. So what I've got on the screen is the initial acquisition analysis, where we calculated goodwill of $9,700. In another video, we've already discussed the fact that it's not raised against BCVR and the normal BCVR entries, but that we cover it in the pre-acquisition equity entries of the parent. Then I've also got the BCVR entries that we paused for the current year, which is relating to the machinery. It's the last year of depreciation for the machinery, but halfway through the year the machinery was sold. So instead of raising the BCVR, we have transferred it to retained earnings. So we have to adjust for that in the pre-acquisition equity entries, but only for the parent share. So only for 75% of that. Now for the pre-acquisition equity entries, we always start off with the entry, or what I refer to as the basis entry on acquisition date, and we have to identify or draw up that entry and then consider the transactions that happened until the beginning of the current financial year that impacts our opening balances, as well as any transactions in the current year that affects or relates to pre-acquisition equity. For adjustments to the parent share in equity, it's important that we split any changes in the equity into whether it's equity that existed on acquisition date, so pre-acquisition equity, or whether it relates to post-acquisition. So we have to split it in terms of before the acquisition date and afterwards, as opposed to the NCI calculation where we look at the timing of the transaction and we're not concerned whether it's pre or post acquisition equity. Okay, so let's get back to the question. So our basis entry would be to eliminate the parent share of the subsidiary's equity on acquisition date. So what does the subsidiary's equity consisted of? We had share capital of 20,000, so 75% of that gives you 15,000. We had on acquisition date the subsidiary had retained earnings of 10,000, so 75% of that is 7,500. They had a general reserve of $2,000 on acquisition, so 75% of that is 1,500. 75% of the business combination valuation reserve is attributed to the parent. The full amount of goodwill is included in the parent share of or the equity that results from creating that goodwill is included in the parent's journal to eliminate their share of the subsidiary's equity, the full amount of the goodwill, and that is eliminated against the shares in the subsidiary, the investment in the subsidiary, which is recorded in the parent set of accounting records. So that eliminates then the investment in the subsidiary as well as the parent share of the at acquisition equity of the subsidiary, and it creates the goodwill. Okay, so we use that as basis, and then we have to see 5 years down the line whether any entries that occurred affected or related to pre-acquisition equity. Now, if you think of the question, what happened with regards to equity that existed on acquisition date, and it mainly results from the inventory that was sold in the first year and the receivables that were recovered in the first year, where we transfer it from BCVR to retained earnings. Once again, note that of the BCVR, only 75% is allocated to the parent. The other 25% will be extracted and disclosed as part of NCI. In the current year, an event that related to pre-acquisition equity was the selling of the machinery that was revalued on acquisition date. So you know that we have to transfer or process the transfer from BCVR to retained earnings as part of our pre-acquisition equity entries. And note once again that we don't put in the full 7,500 here, but only the portion that relates to the parent company. In the end, the full BCVR has to be transferred to retained earnings, but the 25% will be dealt with in the NCI calculation.